Verizon has been one of the worst performing stocks of the last decade. It's been trading at the same price it was trading at in 2011 to 2012. And this is, of course, excluding dividends. It's also one of the most hated stock because it's been pretty much going down for over 2 to 3 years from 2020, and Warren Buffett used to have a position in the company. He sold his position, and then the stock even dived even more. So there's pretty bad sentiment and a lot of fear around Verizon. And this is normally what I like to see in the market before I try to buy a company. But I don't just go and buy, a company for me trying to be a contrarian, like I want to just be against the crowd. Because if something is going down, it's likely going to feed on itself. It's going to keep going down. But if I can find an inflection point in a certain company or something that's changing with the company, this is when I get very, very interested. And I see an inflection point in Verizon that I believe is going to help deal with the two main problems that the company is facing and the reason why a lot of investors have been selling Verizon. I'm going to talk about all of that in today's video. So again, I really hope you enjoy it. Now, the first reason why there's a lot of fear with Verizon is mainly around the debt. The debt has been skyrocketing from around $105 billion of debt to around $143 billion of debt in 2022. This is massive, massive debt. It's growing every single year, and Verizon is pretty much doing nothing about it. The interest expense is eating their free cash flow, although they have low interest expense, but this is pretty bad in general, and Verizon cannot deal with it if the debt just keeps, going up. So one of the reasons people are selling Verizon is because of the debt. The second reason why people have been selling Verizon is they are worried about a potential dividend cut. And you have to worry because if you look at the free cash flow, it has been declining from around $23.5 billion in 2020. Now it's only $14 billion in 2022. And as you could see, the gap between the common dividend paid and the free cash flow, it has been narrowing very, very much, where now the free cash flow is $14 billion and they pay out pretty close to $11 billion in dividends. And if this trend continues and the free cash flow keeps going down, eventually, Verizon is going to have to cut the dividend. And this is a big worry for many dividend investors. And those are the two main reasons why Verizon is yielding pretty close to a 7% dividend. Here it says 6.7, but now Verizon went down a little bit today. The yield is pretty close to 7%. This has also caused Verizon to trade around 9.5 times free cash flow. It used to trade around 11 times free cash flow, as high as 15 times free cash flow, and now it's trading around 9.5 times, which if you look at a historical metric is very, pretty much lower than the mean of 11 times, so it's the lower end of the range. But I believe this has massive potential to change, and we are speculating here. But if we look at what Verizon is trying to do, they are trying to reduce their capital spending around $5 billion from 2022 levels to around $17 billion of CapEx by 2024. Now, this is going to create, massive stuff. And the main reason Verizon can do that is because they were investing heavily into infrastructure, into many other projects like mobility and FWA, which is actually going to help them, save a lot and reduce CapEx in the future. And this is going to be huge for Verizon. And as we looked before, you remember I showed you the free cash flow, it has been declining. And if you look at the trend, it's going to troughed in 2022 around 14 billion of free cash flow. And now the free cash flow is going to go up to 17 billion, 19.5 billion, 20 billion, 21.5 billion by 2026. And you may say, how is this even possible? Well, it's because of the CapEx spending. If you look at the CapEx about Verizon, it pretty much peaked around $23 billion in 2022. And this has caused extreme fear and extreme bad sentiment in Verizon. But as they are reducing their capital expenditure to around 17.5 billion by 2024, this is going to cause the free cash flow to rise, dramatically. And we talked about Verizon, pretty much paying out around $11 billion of dividends. So if they are paying out $11 billion of dividends in 2024, and the free cash flow is 19.5 billion, they're gonna have $8.5 billion of extra money to actually maybe start, paying down the debt, which has a lot of worry. It is gonna also reduce the fear of Verizon potentially cutting the dividend, because if the free cash flow, grows that much, and there's an $8.5 billion difference between, the dividends they pay and the free cash flows they collect, this is going to give a lot of certainty to investors that Verizon is not going to actually cut the dividend. And again, this is really going to help the multiple expansion, is going to help, the share price dramatically. So this is why I believe Verizon is nearing an inflection point, and I don't know when it's gonna come, but as they are reducing their CapEx spending, this is gonna help boost the free cash flow, and then they're gonna have extra cash to start, maybe doing buybacks, to start potentially paying down debt, and it's gonna give more certainty to dividend investors that there's a less and less, likelihood of Verizon actually cutting the dividend. Now, I have to be very clear in this video. It doesn't mean that I'm going and I'm buying Verizon right now. It's on my watch list. I think the company is very, very interesting with such yield. It doesn't mean that I'm trying to pick the bottom on Verizon, because such charts are scary. I mean, Verizon can go to $32 per share. It could go to $30 per share. If it went down from $63, $64, it went to 37. I mean, it could still go to 32 or 31. So I'm not trying to pick the bottom, but I'm trying to say in this video that Verizon is nearing an inflection point because of their lower CapEx spending, and their earnings were actually not bad in the last quarters. They grew revenue 3.5%, wireless revenue grew 6%. I don't have the recent quarter, which is gonna come soon, but the earnings were really not bad at all. But the main worry was around the high CapEx spending. This actually, peaked in 2022. It's gonna start to reverse. Sentiment could start to reverse, and then the share price could start to reverse. But I'm just don't know really when. I don't know how low it could go. But I believe that Verizon is nearing an inflection point, and I think it's a pretty good opportunity at such prices. And the best way, in my opinion, to actually benefit from Verizon is to buy it and collect dividend, but also sell covered calls on your position. I normally, either sell the 2 months covered calls, or sometime I sell the January 2024 covered calls, something out of the money. Maybe it can add an extra 5, 6, 7% in terms of a premium to your yield. So you're already getting a 7% yield. If you could add another 6% to that, this is pretty close to 13% just from yielding alone, without including potential capital appreciation. In total, it could be pretty close to 17, 18% annual on something like Verizon. And if Verizon keeps dropping, you could, buy back your covered call for a profit. And then when it goes up, you could start doing it again. This is what I try to do with British American Tobacco. And we do this strategy with many other, big dividend stocks in my own personal group. So thank you for watching this video. I hope you enjoyed it. I hope you learned something. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.